B1 family, welcome to BLACKlogic. Today we'll be going over the differences between ETFs, index funds, as well as mutual funds. I know this market, when it comes to investing in these group or fund sort of stocks where they're kind of in these baskets, as people explain, can be very confusing. Do I invest in mutual funds? Do I invest in exchange traded funds? Or do I invest in mutual funds? And we're going to break it down. We're not going to make it too long because I know you guys are at work. You guys are trying to invest your money very smartly. And a lot of times within this field it can get confusing. But before we go there, I just want to bring your attention, because this has kind of been in the past year and a half of the recession that we're still going through. Now, we came out of recession into a recession because of COVID-19 and stimulus packages and all these different causes of why America is in this sort of debt right here. We're currently coming upon $34 trillion in debt. And that may be worry for a lot of people. And for some people, if the debt doesn't slow down the way we're accumulating this kind of speed train that we're on to $34 and $35 trillion in debt, well, let me tell you this. Do not stop investing. Be a smart investor, be an intelligent investor. Spend anywhere from 15 to 30 minutes and learn how to invest very wisely, because there's many investment vehicles for you to multiply your money. There's other investments outside of real estate. There's other investments outside of Forex trading that can be just as profitable as some of those particular investments. But again, you have to be somewhat knowledgeable in this area, because I never advise people, in case they needed like very concentrated assistance and support with investing, to go get a financial advisor. Okay. Now, you may need a financial coach, a financial advisor, if you're creating a budget and you're trying to figure out what to do with the amount of income you have coming in each and every year. Those things can be very important. But when it comes to the economy, when it comes to the amount of debt the American has, that should not discourage you from investing, okay? And all these other things are different part of, the GDP and the different deficits that we have occurring throughout America. But let me tell you, $34 trillion in debt should not be a discouragement for people not to invest, even though I get it. You guys, 401ks, your individual retirement accounts, your IRAs, all these different investment vehicles that you guys are trying to build up for your retirement, seems as though it has been dwindling and decreasing because of the current state of the economy. But let me tell you, this is when those millionaires and billionaires jump inside the market, just as well as they've done in the real estate market, to buy up all the stocks, okay? Because they know from the inception of the stock market, and I've told this history before, one of the first stock markets that was recorded was in Belgium back in 1531. But nonetheless, stock markets have always had a history of rebounding and breaking previous records of the returns that have been making for everyone who's involved. So you should definitely be involved in the stock market. Whether it be, I don't know, $20, $30, $40, $50 a month, $5 a day, $10 a day, okay? I know a lot of you guys can afford this, and you just have to allocate a certain part of your budget in order to do this. But let me show you a little bit more here, because I know a lot of times people are not understanding, how did America allow $34 trillion in debt? How do they allow this? Now, it states here that the national debt in the United States increases when the government spends more than it receives in taxes and other revenue. Now, make that personal. When do you become in debt? When you spend more money than you have coming in. You spend more money than the income you have. You spend more money than your salary each and every year, or the amount of money that comes in each and every month. So America is just as bad as us, okay? They would tell you that Americans are the most in debt people in the world. And it's because of the credit system. It's because of the fiat system, okay? Of the system of I owe you, and I will pay you back. We'll make an agreement. Okay, I bought a house. I bought a car. I took out a personal loan and I have to make these payments, right? And rich people who've extended this money, who extended these loans, guess how they're getting the money? Did you know that in America, that people with great credit scores and may have some assets can borrow money, and with that borrowed money, have you to borrow the money that they borrowed? I can't say it any better. They're literally making money off borrowed money at a very low interest rate. And for those of you with kind of weary or credit that is not as, I would say in good standing, okay? Because when we look at credit scores, family, we're looking at 700 to 850, okay? 700, decent, okay, good credit. And then when you start getting past 720 to 750, you're looking at, very good credit. And anything considered over 750, 70, 80, heading to the 800 is excellent credit. And of course, if you have, a credit score of 850, you have grade A credit, but you're not even living at 850 credit score. That means you do nothing with your credit, or you do great things with your credit. It's kind of one of those things like you had no issues dealing with your credit score. But let me tell you, everybody's goal should be at least 700, 720, where you can get into those low interest rates. But I digress there. It states that when the government spends more money than it receives in taxes and other revenue, because that's how the government gets paid, is by your tax dollars. It also states that the debt is made of federal budget deficits, which occur when the government spends more than it receives, yada, yada, yada. You get what I'm getting at. So America is fueled off the tax dollars of those of the working class, those of the middle class, and some in higher class. Because the reason why I don't really group in the millionaires and billionaires, because they have business structures, entities, trusts, life insurance. They have all these different ways of tax deductions where you'll see companies like Google, Amazon, IBM, Microsoft. They barely pay any taxes at all. But this is how America actually gets paid. So when you look at certain politicians that are in different sectors, some trying to create business by lowering the taxes of business because they want these businesses to generate jobs for Americans. And then you have another group they tend to charge these large organizations and businesses higher taxes. And these are the companies that ship all of their work overseas. That way, when you make a call to let's say Wells Fargo, and this is just for an example, I don't know this to be true. You're not getting an American on the line. You're getting someone in India, you're getting someone in the Philippines, you're getting someone in a different country to handle your account. And sometimes that language barrier is a real thing. Now, one of the questions that a lot of people ask themselves, well, who owns the debt? Because where is America borrowing this money from? How are we allocating these different things? Well, here you go. Majority of America's debt is actually from Japan. For quite some time, I thought it was China. But I guess America has now went to Japan to get more money, right? Because Japan owns 1.1 trillion of Americans' debt. China at 859 billion. United Kingdom, you see it, Belgium and Luxembourg, and some oil exporting countries, as well as Caribbean banking centers, okay? But these are some of the people who owns America's debt. But the public owes 74% of the current federal debt. Intergovernmental debt accounts for 26% or 5.9 trillion. So basically they're stating that majority of America's debt is actually owned by Americans. Now, let's jump over to another thing, which is most important and why you guys tuned in here today. Investing. Index funds, mutual funds, okay? As well as your ETFs, also known as exchange traded funds. A lot of times when people are getting investing, or when people even think or have an inkling of what they know what investing is, more times than not, you see these kind of busy screens. You're like, what's going on? I know there's different percentage changes, ups and downs. If you made money that day, you didn't make money that day. And a lot of you guys who are day traders, or you guys are minute traders, right? By the minute, you're making hundreds of thousands of stock changes with different algorithms and different platforms and programs and things of that nature. But some of you, okay, which is kind of the majority of Americans, who are very, very busy day in and day out. You're at your desk, you're working. You don't have time to watch the stock market. I've tried to do it. I tried to do it when I was in the military. And they used to say, why are you always on your phone? I'm like, I'm day trading. You're day trading? Family, this is one of the things that incur a lot of taxes when it comes to day trading. And a lot of you are so darn busy, you just want to set it and forget it. And that's why a lot of you invest in your 401ks. That's why a lot of you invest in your IRAs. But there should be another investment engine, another investment vehicle that you guys put your money in. And this right here, this is, for example, this ain't it. Let's move on. It should be more so information that you can look at to invest in. Now, we're looking at Vanguard 500 Index Fund. Don't look at the price. Don't look at the price, because with platforms like Webull, Robinhood, even Fidelity, they have so many investment platforms where a stock price like this will discourage a lot of people, but you can invest in increments, okay? You can do dollar cost averaging, where you set a monthly amount. Maybe it's $5 a month, $10 a month, $50 a month. Whatever you can essentially allocate, that doesn't, in any way or form or fashion, it does not hurt your budget. But let's break down the meaning of some of these, which is very, very important. ETFs. It states here that it's a type of investment that pools money into a fund. So you have all these different stocks, okay, that may be in the technology market or the blue chip market. You have Google, you have Meta, which is Facebook. You have Microsoft, IBM, who kind of deals in e-commerce like an Amazon, but also in technology. So you have all these different stocks that are in some form or fashion in the same industry, okay? So we're talking about pooling together funds of different stocks. So a fund is different stocks and bonds. ETFs are similar to mutual funds, but unlike mutual funds, ETFs can be bought also on a stock exchange during market hours, meaning that it can be traded, it can be sold and bought like a regular stock, but mutual funds can't. Okay, let's move over to mutual funds. I know a lot of people talk about mutual funds, and let me tell you, mutual funds, in my opinion, are not the way to go. Mutual funds have a lot of hidden fees and transactional fees that they do not let the consumer know. What they do is they give you a bunch of information for you to gloss over and glance over, and then you sign up and you allocate money, and you're wondering, why is it the guy with the ETF and the index funds making anywhere from 7 to 25%, where they're promising me 10%, but I'm only receiving 5%? Because that other 5% are hidden fees in mutual funds that they don't let you know about. It states here that a mutual fund is a professionally managed portfolio of assets that are pooled together from many investors. Again, I know how this can be confusing when you're kind of doing the mutual fund versus the index fund versus the ETF fund. Well, let me tell you this. Mutual funds can only be traded at a certain time of the day, usually at the end of the day. Let's move on. The money is then invested in securities like stocks, bonds, short-term debt, and money market instruments. Okay, let's move down here. Mutual funds can be a cost-effective way to invest. When you buy a mutual fund, you get more diverse holding, yada, yada, yada. Okay, mutual funds can be classified by the principal investment. The four main categories of funds are money market funds, bond or fixed income funds, stock or equity funds, and then hybrid funds. But here's the thing that differs between ETFs, index, and the so-called notorious and infamous mutual funds. These are the things that these portfolio managers don't eagerly tell their customers or their clients, because they're not essentially fiduciaries, right? They're not looking at the best interest of their client, or they're looking at the best interest of the client who actually created that stock, who have actually created that fund. So mutual funds have high expense ratios and sale charges. And expense ratios is kind of like a service charge. It's the charge for doing business. It's the charge of that transaction. And then they say that there are tax inefficiency. That is the main thing here when they're talking about the operating costs, okay, of a mutual fund, as well as a tax inefficiency that a lot of people need to really look at, in my opinion. Index funds. These are one of my best. ETFs and index funds are bar none the best funds that I could ever tell you guys about, okay? It says that it's it's a type of investment found that tracks a market index, okay? Similar to the S&P 500 or the NASDAQ 100. It also states here index funds are considered a passive investment strategy, which doesn't incur as many taxes, okay, and transaction as a mutual fund, because a mutual fund is an actively managed investment strategy where that portfolio manager is making all these transactions, okay, which is incurring taxes, which who is going to foot the bill? You, the investors, okay? And they have all these different types of index funds that you guys can look at, but we're going to take a step further here. It states also that a type of mutual fund or exchange traded fund that seeks to track the returns of a market index. The thing about index funds can be very, very tricky, and which is confusing throughout the market, is because when you're looking at mutual funds, sometimes you'll see the word mutual fund, but you have to get into the details of it to see if it's an index fund. I know I have some examples for you guys to look at. That way you don't get totally confused about what the hell I'm talking about, because there are differences that you guys need to look at, okay? So when I'm looking at how to invest, especially in index funds, okay, I'm coming over here to NerdWallet. It says that actively managed funds, we're talking about mutual funds, often underperform the market. Why would you ever do something that underperforms the market? So before we get into that, there are some things we really have to talk about. All right. It states that actively managed funds often underperform the market because you have to look in those transaction fees of mutual funds. And again, this is just my opinion about this, family. Let me tell you, I stay away from mutual funds like the plague. I stay away from mutual funds like the jab. Excuse me. I stay away from mutual funds like COVID-19. It says, while index funds match it as a result, passively managed index funds typically bring their investors better returns over the long term. You see that? Passively managed index funds, okay? Mutual funds of actively managed, which underperforms the market and incur more charges, and index funds kind of stays with the market and overperforms the market and bring better returns over the course of time. It states here, plus they cost less as fees for actively managed investments tend to be higher. Let's move down here. As I stated before, just like ETFs, mutual funds, as well as index funds, are a group of securities, which is known as stocks. Let's move on. Now, one of the most important things here is the expense ratio that a lot of times people are not aware of. What is the cost of doing business? What's the operating cost? What is the service cost? Expense ratios are fees that are subtracted from each fund shareholder's return as a percentage of the overall investment. It's the cost of doing business. Let me go over to my portfolio to show you guys. Here's one of my investments, Invesco Triple Q, okay? So we're going to get into some of the details here. And as I was stating, that these funds, okay, like this particular index fund, as you can state here, Triple Q tracks a modified, let me blow this up for you guys. It said that it tracks a modified market cap weighted index of 100 NASDAQ listed stocks. What does that mean? If you go to the NASDAQ and look at the stocks that are listed within, this one actually tracks it and try to match it in order to gain the stock price to increase for your overall portfolio. The listed name for Triple Q is Invested Triple Q, blah, blah, blah. All right. Here are the different sectors in industry that Triple Q is actually involved in. As you can tell, that this particular fund is technology heavy, with over 50% of the stocks that are in this fund are in the technology market. And you see the different markets it in: industrials, healthcare, communication services, financial services, real estate, utilities, etc. And one of the things here on Robinhood, you can just click on that particular sector and it kind of breaks down those things. And then you can also look at the stocks that they have with inside this. If you come down just a little bit here, it states that it invests in Apple, Microsoft, Amazon, Nvidia, Broadcom, anytime you're looking at the alphabet class A and C's, you're talking about Google, Tesla, and Adobe. These are the technology stocks that are listed inside Triple Q. And take, for instance, you wanted to see what type of hair stocks that are in there. They will show those as well. Let me see if I can get those popped up for you guys. They're kind of just showing only the top 10 holdings. A lot of times you can click on these and they will show you these stocks. So I don't know what's going on today, but nonetheless, you get the drift what I'm getting at. Now, the key statistics or the information therein, okay? A lot of people may know this as a prospectus report. That's a report that anytime an organization builds a stock, this is something that the SEC requires for them to have. But we'll get on that a little bit later. Now, the key statistics here, you're looking at the high for today at 390, the low for today at 385. Looking at the 52-week high, that means a year high. What is the highest amount year to date, okay, this year to date, that this stock has been to? 394. And what is the low? 259. But what's most important here, as we spoke about before, is the expense ratio. How much is it costing me to invest in the stock? And let me just kind of let you know this, which is very important. Anytime that you see the expense ratio under 1%, that is a very cheap operating and service charge. And I believe if that's the stock you want to get into, you should invest in. Does that make any sense? These are one of the stocks that you should invest in. Now, I'm not giving you quote unquote stock advice about investing in Triple Q. We're talking about the expense ratio and that it's a low operating cost that's not going to cost you a lot of money. We're talking about 0.2%, not 1%, okay? That's after the decimal point, so to speak, okay? Then, of course, with Robinhood, you get a lot of news. You get, okay, this is my history of how you see some of the dividends that I've gained. Not much, just 80 cents on a dollar. Now, and overall, my portfolio performance with this, I'm not even, I guess I'm what, 1 share inside of this stock, 1.4 shares, because I do dollar cost averaging. I allocate a certain amount of money each and every month to invest in my stock portfolios. Let's move to another one, which is one of my favorites, which if you guys are getting into index and mutual funds, I would definitely say one of the best returns I've been receiving is from Vanguard. And we're going to go over to Vanguard. That way you guys can look at the list of stocks. You can look at the return. You can look at the history. All these things are very easy, and it takes, believe me, 5 to 10 minutes of your day, okay? 5 or 10 minutes of your day to understand how investing work, how index and ETF stocks work. But again, in my opinion, stay away from mutual funds. They could be very, very costly over the course of time. Now, and again, do not look at the stock price because there are smaller, much less ETFs and index funds that you guys can invest in. And when we're looking at this, I know a lot of you looking at the $456 price tag, like that's for 1 share of that stock. Absolutely. But again, with investment engines like Webull, Robinhood, and others that you guys probably already a part of, you can just invest in increments. You can do $5 a week or $5 a month and still invest in stock like this and still get the return. Okay. So when we look at the return here, what we're looking at is the 1-year return. Okay. Let me get off here very quickly. And we can tell here that the percentage that this stock has done for me, my total return is 15%, which is pretty good. When you're dealing with these particular funds, exchange traded funds and index funds, anything over 7% is very, very good. When you start hitting 12 to 25%, now you're looking at real estate, people who have actually brick and mortar real estate, not those people who kind of flip, but those people who buy, hold, renovate, and rent out. You're looking at their kind of returns when you're dealing with index and exchange traded funds, because I know a lot of you just want to set it and forget it. And in my personal opinion, family, this is the way to go. Index and exchange traded funds, okay? So far, I'm up 15%, only at $55. But again, I'm still making money. That is the key here. And also, this is a fund. This is a market-weighted index fund. But this is solely in the technology market. As you say here, it tells you the sectors. This is 99.4% in the technology market, okay? Which is, I mean, let's just be real. Technology is definitely taking over with AI, automation, robotics, you name it. In this particular fund, you're investing in multiple stocks at one time. You're investing in multiple stocks at one time. So if you were to go over here, invest in Vanguard Information Technology ETF, you would thus be investing in Apple, Microsoft, NVIDIA, Broadcom, Adobe, Cisco Systems, Salesforce, Accenture, Oracle, and AMD. And the one thing that people always say, are you investing in that Apple stock? It's going up. Yeah, I'm investing in Apple. Because you understand that you are investing in index and you are investing in mutual funds, in exchange traded funds. So when we look at this, you are investing in all of these particular markets. Let's go down to the key statistics, okay? And the one thing again, expense ratio, only 0.1% when we're talking about Vanguard. Vanguards have very, very low expense ratios, those operating and service charges that we will see as we go through this video, that a lot of them are more than 1%. And these are the things that they hope that you guys are not readily noticing when you're investing. And then you have the 30-day yield. There's just a lot of information here, but we're sticking true to ETFs and index funds. And kind of here's my history of what I've been doing, my reinvested dividends. And that's another thing on a lot of these platforms, you can actually, any dividends that's coming to your investment account, you can set it on automatic reinvestment of that particular fund, of that particular stock. Because again, when I'm thinking about investing, I'm only selling my shares. I'm only selling my stocks when I absolutely have to. It's almost like a secondary emergency fund, okay? Which needs about 3 to 5 days to clear once you sell your stock. But it can also work as an additional emergency fund if your emergency fund in your savings account is not enough for what you're trying to do. And then the second reason why I would sell my stock is to invest in another investment. Does that make sense? Like maybe I have 30,000 that I'm investing in the stock market, but I have an opportunity to buy a real estate property, or someone come to me with a business venture and they say, hey, we want you to be part owner. You need to come up with $10,000. Okay, I'll sell a portion of my portfolio and make that another investment, okay? And there's ways to roll that transaction fees of the taxes that it will incur when you sell those stocks into that investment. But of course, that is yet another video, okay? Let's move over to Vanguard, okay? Let's move over to Vanguard. I think this is a great way for you guys kind of research stocks here. I blew it up for your viewing pleasure. And they have all these different segments where you can just look at mutual funds and ETFs, mutual funds, or just ETFs. We're focusing simply on mutual funds. And I want you to guys not only to look at the asset class, because you can invest in bonds as well, because those have index and ETFs as well. Expense ratio, very, very low expense ratios, okay? You also have year to date, the different performances throughout different years. And it also tells you when they created the fund, okay? 2007 is where they created the short-term bond ETFs. And if you want to go back and forth, just take the symbol BSV, go into Robinhood or whatever investment platform you have and type in BSV. And you can look exactly what that is. And it's kind of better to look at in some regards, okay? It says Bitcoin SV. And you can look at the performance very easily over here, okay? And it can break down certain things for you, okay? But as we go through these things, there's a lot of things that people are not essentially looking at. And you can buy these directly from Vanguard. But I would tell people, one of the things I try to do is keeping all of my stocks on one platform that are within the same sector and or industry. I used to have all sorts of investments accounts all over the investment spectrum. I used to have a Charles Schwab account. I used to have, I still have my Webull account, but I also have Wealthfront. I have Wealthsimple. I used to have all these investment engines, but I started to really condense them. So I'm not looking at 10 platforms of the only 3 industries I'm really investing in. So you really, really want to maximize your stock platforms and the shares that they actually offer, okay? So let's look at risk. You see, they even have risk here on Vanguard, which is a great tool, meaning that these bonds are very, very low risk. You know why? Because quite frankly, family, when we're looking at bonds, 3 type of major bonds. You have government bonds, corporate bonds, and junk bonds. Now, the first 2, the government bonds are the most very, very low risk bonds. Okay, those are most steady bonds, but you're only going to get anywhere from 1 to 5% on government bonds. Corporate bonds can tend to be anywhere from 1 to 10%, and then junk bonds, you can almost get 20%, but they're very, very risky. Don't invest in junk bonds, in my opinion. Don't do it. Okay, but as you can tell here, it's like this one right here. It says the VTIP. Okay, the short-term inflation protected securities. Is a government bond, and it goes up to 3.82%. And then, here's the thing. I wish this was a floating headline. That way guys can read it along. But anyway, 1.5% over the course of time. So let's increase our risk. Let's increase our risk to 5. Look at Vox, communication service ETFs. Well, look at the year-to-date return, 37.92%. 37.92%. Now, real estate investors were telling me, having brick and mortar, because when I get in trouble, I can sell a property. And they're right. They're absolutely right. But when I'm looking at information, the historical references of when the stock was first conceived, meaning created, and then year to date, like how has this stock performed? I want a real estate investment to tell me that you're getting 37.92% return on your investment. Now, a lot of them can actually do that when they have multiple properties, but somebody who has like 1 or 2 properties, you're not getting this unless you're just you bought this property a long time ago, and now they gentrified this entire neighborhood, and now you're getting these returns, right? Because you raised the rent, you renovated it, you made it look more modern than what it is. And now you're getting these returns. But family, let me tell you, a lot of these stocks here, look at the expense ratio, 0.10%. And the year-to-date return is almost 40%. That is phenomenal, okay? That is absolutely phenomenal, okay? But we do have to factor in the since inception date. It's only around 7%. But there's a lot of ETFs that you guys can walk through, look at the numbers, see the return, look at the risk factors, all right here in a very robust sort of way that you guys don't have to do all this research. And the one thing I like about Vanguard, again, they became a $1 trillion company. I think they're worth over $5 or $6 trillion, is by their index funds. That's the one thing they implemented that took them over that $1 trillion mark to start offering low-cost index funds, okay? You guys can't go wrong, in my opinion, when you're talking about ETFs or index funds, because your ETF funds are your hybrids. Mutual funds and index funds are traded once per day, usually at the end of the trading day or at the beginning of the trading day, where ETFs can be traded throughout the trading day, but they're still passively managed, which doesn't incur a lot of the tax charges. So they're hybrid stocks. So that's why I was kind of leaning towards people who may want to trade here and there, your index. For you guys who want to set it and forget it, your index funds. Very easy, family. This is not hard. This is the way that you guys can make some decent money on the side just by investing an allocation of, let's say, $50 a month. You guys can do that. You spend it at Starbucks, do you not? Moving along. Here's another website where I just kind of did a quick Google search of the 100 highest yield year-to-date ETF returns. Now, I looked at some of these. I looked at this one here on Robinhood, $25. But let me show you something here. Let's go over leverage very quickly. They break it down for you. It states here that if a regular fund rises by 1% in a day, then a 2 times leverage fund tracking the same asset may rise by 2%, which is good. But it can go the other way. If a regular fund falls by 1% in a day, a 3 times leverage fund tracking the same asset may fall by 3%. So it's kind of one of those damn if you do, damn if you don't. But nonetheless, it can still be profitable depending on the risk factor. Let me show you something that I've been telling you guys for quite some time here on this video. 2.46%. No, 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 no. That expense ratio is grotesquely high. I told you anything over 1%, in my opinion, I will not invest in it. Are there exceptions to the rule? The exception to the rule, if this is a stock that is returning year-to-date high returns, like 410% of return year-to-date, then is it worth it? Yes. Let's go back. Let's go back. Again, I told you this can be confusing, but I'm trying to make it as simple as possible for you guys. So I'm looking at 1 year of its performance record here, okay? I'm looking at 1 year of its performance record, and I'm looking at the trending analysis here, looking at different points. Where is it peak? Where did it dip? And then, believe it or not, there's environmental factors when you're investing. What happened during this time? Was there another COVID scare? Was there a war? Was there a conflict? All of these external factors that you guys see on the news play inside the stock market, believe it or not. But right now, this stock is doing very, very well. And we're looking at December 4th. Okay, I'm trying to get it up here. December 4th. It's already up $18, 244%. Wow. And that is because this stock is actually leveraged. So when we look at it, this 2.46% ratio, I'm not so much worried about it because this is the exception to the rule when you're talking about 410% of a year-to-date return. That's good money. That's good money, family. I can't lie to you. Let's move on to FNGU. This is the one right here. FNGU, 356% year-to-date. We're going to go over here. What is the actual stock price? 187%. We're looking at a year out, and we're up 126. Okay. Let's see where we are today. We got here December 4th. We're up $126. Okay. And then the expense ratio, believe it or not, is actually under 1%. So these are some key factors that you guys can be looking at as well. But again, you can just do a quick Google search and look at the highest yield year-to-date returns for ETFs and or index funds. So there are a lot of investment engines and tools that you guys can use. You just have to look for it, okay? Because as I stated before, ETFs are like the superheroes because they're the hybrid of the investment world because they combine the diversification of a mutual fund with the flexibility of trading individual stocks, which is unlike mutual funds, which are bought and sold at the end of the trading day and at the net asset value, also known as the NAV. ETFs are traded on the stock exchange throughout the entire day, allowing you to jump in and out the market depending on the price. Because mutual funds have been around the block for a while. They're a collection of stocks, bonds, just as well as index and ETF funds, stocks, bonds, and other securities managed, here's the key, managed by a professional fund manager. In some regards, family, that could be tantalizing, right? That could be absolutely tantalizing. That could be great for you. Oh, yeah, I want someone to manage my account, but it's going to cost you. It's going to cost you greatly. So these are the actively managed account. They incur taxes as well as portfolio management fees that you guys should steer away from. Now, while they offer, a diversification, the catch is that they only get priced at the end of the day, and there might be a minimum investment requirement. But on the other hand, index funds that track, the S&P 500 and the NASDAQ, their performance is of a specific market segment. They're more passive. That's called passively managed, mirroring the ups and downs of the market. The thing is, you can't directly invest in an index. Did you know that? You can't directly invest in an index, but you can invest in funds that aim to replicate its performance. So you're kind of thinking, then which one? Now, we already kind of X'd out mutual funds that are not. But when we look at kind of the risks of all these, different investment engines, ETFs, in my opinion, steal the show. They have low expense ratios and tax efficiencies, which are important. Ain't nothing like investing, and then all of a sudden you owe all these goddamn taxes. I hate to say it. There's nothing like investing, and then all of a sudden you owe all these damn taxes, which are not good at all. I know you guys absolutely hate taxes, but when it comes to ETFs, you have the flexibility to trade throughout the day, which is kind of a big thing. If I used to be a day trader, then I used to kind of do weekly trades and I kind of do monthly trades. Now I'm more so of a set it and forget it guy. I have other things that have my attention where I cannot be trading stocks throughout the day. So even when I was given these, I always had ETFs funds. I always have index funds because I understand that they incur low taxes and they have low operating service charges, also known as expense ratio. So if steady growth is your game, ETFs could be, your most valuable player. It could be the most valuable thing that you invest in, because mutual funds, while they offer those professional management people, they will carry higher fees, and they're not tax friendly at all. They're not tax friendly at all. Like me, I'm not too tax savvy, but I understand taxes. And when I go to my CPA, I give them all of my, paperwork for my investments and, all my debt and, liabilities and assets. The worst thing he can tell me is you owe X amount of dollars on taxes, because I always want him to maximize my tax deductions. I give to charity each and every year to lower me in another tax bracket, so I do not pay taxes. Okay, that's the key. When people are yelling about this organization and this company and this person hasn't paid their fair share of taxes, they're using the tax code. They're using the tax law to evade and avoid taxes. And if they're doing it, why should I be getting mad? I should be learning how to do this, or in my defense, hiring a tax professional to do it for me. I don't have time to learn certain things, family. I just don't. But when we're also looking at index funds, if you're all about, mimicking how the market is performing, and you kind of want a set it and forget it approach, I told you index funds are the way to go. Okay. They're not as hands-on as an ETF, but they could provide stable returns over the long haul, because in the end, it boils down to your financial goals and your risk tolerance. Okay. A lot of you guys I'm young, I can incur more risk. And that's what it should be. That's what it should be. You should be really working on a life cycle when it comes to your risk tolerance. Because ETFs are, they're kind of like the cool, adaptable sidekick, always ready for action. You can trade, and it doesn't incur that many taxes because it's that hybrid between a mutual fund and the index. But mutual funds, they're kind of like the seasoned sort of stocks that people have been pushing and promoting and advertising and marketing. But they're not as agile as an ETF or index fund, especially when you're talking about the risk level as well as the tax efficiencies of these other ones. So I really, really want you guys, in my opinion, to stay away from these mutual funds, because I believe in that sector, there's not a lot of fiduciaries who are looking out for the best interests of their investors for maximum returns. And one thing I said before that I kind of want you guys just to be aware of, when we're talking about prospectus, let me show you guys this very quickly. When we're talking about prospectus, I know you can't read that, but this is important for every stock to have, okay? And this is an example of the stock that we looked at previously too, and this is their so-called prospectus that I believe that you guys should look at. And the purpose of a prospectus is to provide potential investors with information. So again, the prospectus is for you, the investor. It provides you with the information to help make an informed investment decision, because it includes details about the company, its history, what is it offering. It outlines the level of risk associated with the making an investment in the stock, I mean, a prospectus includes information on the company's business operation, risk factors, performance outlook, management structures, the financial, which is absolutely important, I would like to believe, to every person who is an investment, okay? And I'm not gonna go through this because it's a plethora of information that you guys will have to comb through. And this is to make sure they just, they're doing the right thing by the SEC. They have to have all this information here in order for you guys to be well-informed investors, okay? Because a lot of times when you guys are looking at stocks that split, like you're looking at a Tesla or an Apple, Amazon, all these stocks that kind of did that split years or so, they did that for you guys to invest more money. They did that anytime they're splitting stocks, they're creating more stocks for people to invest in because they want to increase the investment money to make new products, okay, for the investment shares to go up. Let me look at them very quickly on my portfolio here. Let's look at this. Okay, let's look at this very quickly on my portfolio here. I got some cryptocurrencies. Of course, they're not doing too well. Bitcoin is only at 41,000, but I think I have like over $9,000 in Bitcoin. Let me look at this. I guess 8,000 now. It's I don't even have one Bitcoin yet, but this is how much money I've invested in Bitcoin. And look at my total return at a negative 90%. Okay, so this is where those real estate gurus will top investors who do not diversify their portfolio invest in real estate. I'm talking about brick and mortar because all these are digitized investments and we're just waiting for Bitcoin to go up. And the only thing that makes Bitcoin, in my opinion, valuable is the technology behind Bitcoin, which is blockchain. Okay. I won't go in detail because I've done detailed videos about that. But I'm waiting for NIO to come back up. And listen, if NIO Chinese electric car vehicles don't come to America, I would have thus lose a lot of money. And if Donald Trump becomes president, hopefully he doesn't put more tariffs on China because, again, let's look at my NIO just for an example. I just want to look at my NIO just for example here, okay? Not to be too political. I'm going to show you where this stock was prior to Donald Trump making the tariffs. NIO was worth $61, $62 per share before Donald Trump enacted all of those tariffs. And after that, this stock has not recovered, okay? I'm a negative $2,000 in the hole. And one of the things that a lot of people tend to do, they tend to sell their stock when their stock is in the red. Don't do that. It's already done. This going counted. My market value for this stock is only $500. And I'm $2,000 in the hole, okay? And they said that the average cost of when I was buying these stocks was $37.51. Believe me, I'm nowhere near the amount of money that I've spent or that I've invested to obtain these stocks. So that means in order for me to break even, I have to wait till Robinhood gets up to $37 in order to break even. So at this point, I literally set it and forget it. I don't know the last time I looked at NIO. Okay, I have stock alerts. I have stock alerts that actually help me. So I'm not going to relook at it until one of my stock alerts like, hey, NIO's over $37. It hasn't happened yet. But here's some of the stocks in my portfolio. I have NIO, Plug, Apple, Grow Generation, Tesla. I have almost 21 shares of Tesla. Let's look at Tesla. I know a lot of you guys are familiar with Tesla, so let's look at Tesla. 1 year here return. So I'm up $47 at roughly 25%. The market is live, so you're going to see a lot of fluctuations there. But my total return is $1,400. I'm up 40%. That is really good. I'm doing really good with Tesla, okay? Not necessarily the likings of Elon Musk, what he's doing with X, but when it comes to Tesla and this investment, keep on doing what you're doing, Elon. Loving the money coming back, okay? So as we're looking at this, I'm not looking to that. I just know that my portfolio, when it comes to Tesla, is doing well. What else do I have over here? I have Blink, Okay, I think this is the charging. Yeah, Blink charging. And what's important about Blink charging, even though I'm down, I only have like four and a half shares. I think I really should be buying more Blink charging. The electric vehicle market is not going anywhere. It's not. It's not going anywhere. So companies like Blink Charging, and I will say this, you can look up Blink Charging News, but a lot of this information is embedded into Robinhood's platform. Okay, let's look down here. At one point in time, within the past year, Blink Charging was up $15. And look what the analyst rating got. 10 analysts stating hold Blink Charging, and 30% is saying buying, while 0% is saying sell. Okay, we're looking at the quarterly earnings. You have to kind of dive into the stock news. What is Blink Charging doing while their quarterly earnings, okay, the actual estimated per share is kind of flatlining versus kind of the EKG, boop, boop, kind of showing the liveling of the stock. And again, as I told you before, they have my history here of the lending payment, blah, blah, blah. Then they also have down here, which I love, other stocks that are in the same sector like ChargePoint. ChargePoint is another one that we can kind of look at too, okay? As the electric vehicle car market is growing, these stocks will become more and more important. And it states here, look at my call. I have a call for ChargePoint that's out to 2026. And so far, I've only made 64 cents. But that's okay. That's okay. I can still buy individual stocks, but that one day will become profitable. And here's some of the news I was referring to. ChargePoint holdings advance while market Yahoo Finance. You can go into that. Tells you why it closes, where they predict where it's going to go. Why ChargePoint stock hit a new all-time low today. Tells you the reasons why. But again, it says hold at 58%, buy at 37.5%, and sell at 4.2%. And then they tell you what the bulls and bears are saying. Now, the bulls, meaning these are the analysts that believe the stock is going to increase and why, and the bears believe this is why the stock is going to decrease and why. So I'm going to read the bulls very quickly. ChargePoint is the unquestioned leader in the AC level 2 market with over 50% share. They're talking about some charging vehicle level stuff, right? ChargePoint capital-light business model provides potentially high returns on capital and limits risk to utilization levels. ChargePoint provides investors leverage to the expected long-term growth in EV adoption. Okay, and I'll just expand this for your viewing pleasure as well. It comes down and say that ChargePoint long-term success will hinge on its ability to successfully penetrate the DC fleet, and I believe that's direct charging when they say DC, and the European markets. And that's another good thing about ChargePoint. They are in the UV markets, and they have good quarterly returnings as I'm looking here. Let's see here. They're showing my one contract that expires in 2026. I kind of bought it on the low end, but I did stretch it out so I can sell this or have the right to leverage that particular call option, okay, to ensure that call option. So that's important as well. I can buy it later on and exercise it. Even if it drops, I can still go in and buy it, okay? So those are some of the things that I look at that I think is very important. I see I have 7 of 7. Jermaine Anderson, thank you guys for joining me here today. I guess we've been here almost an hour. I didn't expect you to be that long, but I know that when it comes to investing, this is very important to the family. I think that Money Mondays is very important for you guys to tune in. Make sure you're sharing with your family because, again, when this channel was Raw's World, I was given a plethora of investment videos, saving videos, budget videos, financial videos. And on Mondays, we're going to return true to the game. We're going to come back because this is where you put your money where your mouth is. You guys should be investing. You should be maximizing the income that you have coming in and not just investing in your 401k, not just an IRA, but also having another investment engine. Yeah, we're in a recession. So what? There's all sorts of people still investing, and there's many investments, as I showed you guys before, that are still being profitable for people, So if you guys want to look at this website, this is etfdb.com, etfdb.com, and it's showing you the 100 highest year-to-date ETF returns. And believe me, as I showed you guys before, a stock like this is only $25.72 per share. And look how much it's already been up. And then it's one of those leverage stocks that works in your favor most of the time, not all the time, okay? So when we look at these investment engines, family, please utilize this information wisely. Again, my opinion when it comes to mutual funds, stay clear and stay far away from those traditional mutual funds. When we're talking about ETF funds, about trading throughout the day, these are your hybrids that are passively managed and don't cure a lot of taxes, but they can be traded. When it comes to index funds, that's more of your set it and forget it. You do dollar cost averaging, where you allocate a particular amount each and every month, and it will buy that stock in increments. Okay, I'll give you one example. If you want for share, you see me investing in increments. Okay, get back to popping up here for you guys. Okay, we'll kind of look through my portfolio here. You'll see the shares like Tesla, 20.94. That means that I've been just investing in Tesla in increments, right? It might have my history of what I've been doing here. Let me see. Okay, we went through all this information. Shareholders call. A lot of time I tune in with them. See, look at that, $7. Look at this is what you call micro or fractional investing. And that is what I've been doing. I've been fractionally investing $7, $1.68, $257. Whatever I have to invest at the time, you guys can still invest. Okay. Let's see. 707 said, do you recommend Bitcoin, Ethereum, ETF investment where they become approved or just by the asset itself? A very good question. I would tell you what I would do. If you really want to get into, the Bitcoin space, the cryptocurrency, the token space, I would alternative coin space. I would definitely do an ETF. In my opinion, I would definitely do an ETF because your risk factors are a lot lower. And believe it or not, I did a video ago. There was these two sort of Bitcoin sort of stocks that I was telling people about that are, give me a second here. I guess I can't talk and type, those people can. I was telling people to invest in that could be profitable because, let's see, Bitcoin, it was a bit, I think it was a Bitcoin blockchain. I forgot the symbols on these. So you have to bear with me when it comes to this, because I have a lot of financial videos. Family guys can dive. The very quick question asking, believe it or not, I do have a video on it. You just have to go find it, unfortunately. Okay, but I'll try to do my best here. What I'm working with. Let me see if it can pop up here. There was a blockchain one that I was investing in at 1/4 time. Let me see if I can find it very quickly here. Let me see if I can find it. Yeah, I cannot find this particular one, but it had to do with Bitcoin. It was an ETF. Bitcoin Cash, Bitcoin SV. Unfortunately, family, I cannot find it. So here we go. Here's one. And this is, for example, this is not the one I did the video on, okay? But I will show it. Okay. Let's see here. Pro shares, Bitcoin strategy, ETFs, or futures. Let's see what's inside of this. Okay, It's not really showing me what's inside of this ETFs. I like to know what shares inside of this ETFs, but it does have its prospectus for you guys to look at. Okay. Let's look into crypto futures. They just kind of giving you a breakdown of what that is. Yeah, unfortunately, it's not showing me what coins are in this one. It's just kind of a Bitcoin strategy ETFs. But as you can tell, it's been doing pretty well. It's been doing pretty well, as you can tell. Okay. So the percentage is up 92% in the past year. And let's see here for today, we're looking at, stay with me, where we at? At almost $10. So it's doing pretty well right now. But again, do not forget that stocks as well as anything in the Bitcoin or cryptocurrency space fluctuate throughout the day. Okay, family? You guys have a great one. Hopefully you guys are investing and still investing. And as Warren Buffett would say, the transfer of wealth is from the impatient to the patient, meaning that you guys who see that your stock portfolio or particular stock and your shares are decreasing in value, decreasing the amount of money that it's worth, you sell, sell, sell. And guess what all those rich guys do? All those rich guys come in and do buy, 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 because they know time is on their side. They know that time in history has shown them that all of these stocks, all of these funds, majority of them bounce back and break records of the amount of money that it has yielded. You guys have a great and wonderful day. I see you guys on the next one. Be one.